Welcome to Electrified. It's your host, Dylan Loomis. Quick shout out to my newest patrons, Shalom G, Del Spiva, and Roger M. Thank you for choosing to support the channel. The accountant on the Tesla Motors Club forum posted this, talking about how this Q4, Tesla could have its first immaculate quarter, or a clean quarter where we don't have any of these headwinds that we've had over the last few quarters. Things like production shutdowns for upgrades, COVID lockdowns, Bitcoin impairments, the list goes on. But first, talking about Q3, as you can see, he has C and G for potential headwinds that would prevent an immaculate quarter for Q3. C, Shanghai and Berlin line upgrades, we know about that. And G, negative margins coming out of Austin as Austin continues to ramp. It's been reported that Berlin is already profitable despite operating at a fraction of the ultimate capacity. I would just caution though, for a global company like Tesla over any 3-month period, the chances that nothing goes wrong are so slim for a company like this. I mean, think about things like a potential energy crisis in Q4. There could be more COVID flare-ups as we're starting to see in certain areas. Scaling of 4680s could continue to be more of a challenge than Tesla anticipated, and although that may not have direct Q4 impact heading into 2023, that's going to be critically important. Of course, I would love to be done with COVID as much as the next person, but just yesterday, Volvo said they're closing a plant in China in Chengdu due to COVID lockdown, so we're not out of the woods yet. And shifting back to optimism, there are some other tailwinds like Tesla recognizing some of the outstanding deferred revenue, mainly from FSD, to the tune of $1.5 billion, among a few others. So I thought this was a good post, and some optimism around Tesla's Q4 is definitely warranted. Maybe it won't be immaculate, but it could be one of the cleaner quarters that we've seen in recent memory. Next up, we have the inside of an Electrified America charger on the left and a Tesla Supercharger on the right. Notice the difference? No explanation needed. Electrify America on the left is what we call an MVP, a minimum viable product, whereas the Tesla Supercharger is a great example of vertical integration and electrical engineering. Not only do these differences mean Tesla Superchargers are easier to manufacture, but they're also cheaper. There's been some back of the napkin math done from some public documents that say Tesla Superchargers could cost around $40,000, where Electrify America and some of the other competition could be closer to $200,000, meaning superchargers are around 20% of the cost of the competition. Not only that, but we know Tesla has its prefab process for installing these superchargers where they're pre-connected to concrete slabs and then just shipped and dropped down and essentially connected to the grid. All of these differences that currently exist in the background and most people are overlooking are going to matter more and more with more time passing and scale. And to anybody that would say, well, Tesla has other big devices and cabinets at supercharger locations, I would just say, well, so does Electrify America. There's a new product on the Tesla shop, stainless steel, satin finish, says powered by the sun, a new license plate frame. Speaking of the Tesla website, there's been a subtle design change. Now we have some sharper edges and more rectangles on the site. This was an interesting anecdote. How long can a Tesla owner sit in line with 0 miles of charge as they wait to charge? The answer, I made it 22 minutes waiting in line with no AC and 4 minutes driving prior to that, 30 miles an hour or less, for a grand total of 26 minutes at 0% and 0 miles. From a user on Reddit, apparently loaner vehicles are now showing up in the Tesla app. I'm sure some people are saying, where is Tesla actually still giving out loaners when people have service appointments? But here's the screenshot of the service appointment and another screenshot of this user's loaner vehicle. From Drive Tesla Canada, California is now reporting a 15% of its total vehicle sales as being electric. This 15% share is significant compared to the 5.6% share nationally. The national percentage is still a massive improvement, over 2.7% in Q1 last year. And positively or negatively, depending on how you view it, when hybrids are accounted for, the EV share in California jumps to 30%. Jorg Steinbach, Brandenburg's economic minister, said, Tesla's START program with 120 trainees and dual students at Tesla in Grünheide. I'm happy about the commitment to training. Tesla will thus become the largest training company in Brandenburg and will help young people have good prospects with us. A few weeks ago, I showed you guys the wallet I've been using for most of this year. Well, I upgraded. Same brand, just a different style. So shout out to Ekster, the sponsor of today's video, for sending me this bad boy. I'm loving this one because it has this extra privacy cover with 2 extra card slots. It still has my favorite quick access card feature, but this one also has a custom slot for an Apple AirTag. Yes, I have mine in upside down to protect the silver side. No worries if you're not an AirTag person, Ekster has these sick solar powered tracking devices that pair with your phone. You can ring this device with your phone, and you can ring your phone with this device. 2 hours of charge in the sun will give you 3 months of use. Ekster also gives you peace of mind when it comes to wireless theft, as Ekster has built-in RFID blocking. I've been impressed with the material so far. This thing has been through the ringer already and it looks brand new with the same compression. Once again, even if you only have 1 card, there's some magic here where it will not fall out. Ekster has a wide variety of options, styles, colors, and even some other gadgets to choose from. So head to the link in the description below and check out the Labor Day sale. You can use my code Electrified to get 25% off and a free cash clip with all purchases over $150. Happy shopping. All right guys, so here it is. Moodys has officially responded to our good friend Alexandra when it comes to the possibility of Tesla's investment grade credit rating upgrade. Listen to this. A Moodys rep says the considerations are not so much a quantitative nature, but more qualitative. Importantly, we're looking for a broadening of the company's product lineup. Today, Tesla remains narrowly reliant on primarily 2 models, that would be the 3 and the Y, albeit highly successful ones. Note also in this respect that one of the models was first introduced in 2017. More concrete prospects for a broader vehicle lineup would be regarded as a positive development in this respect. Further, the ratings could be upgraded if Tesla successfully expands its global footprint, maintains a strong competitive global presence as other automakers offer an increasing number of battery electric models, aka here we go with the competition is coming, and improves its product breadth. Tesla's ability to sustain an EBITDA margin of at least 7%, excluding credits, and a consistent, prudent financial policy are also important considerations for higher ratings. Lastly, Tesla will need to maintain very good liquidity, including ample cash and considerable committed availability under its revolving credit facility. First, and maybe most importantly right here, Moodys is admitting this is probably more subjective, aka qualitative, than it actually is quantitative. Second, this whole Tesla needs a wider product offering I think is one of the worst arguments going. Just because historically no car has really sold more than 1 million units of any type of vehicle per year doesn't mean that a company in the future can't do it. Remember, legacy auto is in this bucket of the past and Tesla is this entirely separate entity that's the bucket of the future. These 2 buckets are going to have major differences. We've heard this many times before. Gary Black highlights one case here from Tony Sacconaghi, who's struggling to see Tesla doing 3 million units per year based on just the Model 3 and Y. Then they give the argument the best-selling models to date only do around 1.1 million units per year. Well, if you divide 3 million per year needed by 2 models, that's only 1.5 million units per model. Not that big of a gap for what the highest volume units are doing right now. And can we talk about what the actual connection would be between Tesla having a broader product lineup and having an investment grade credit rating? I think the link or the argument would be that this would de-risk Tesla's business model, but if you think the Model 3 are at greater risk of a demand cliff than all these other automakers having 20 or 30 vehicles to choose from in the ICE segment, I think that's a very flawed argument. Here, Moodys brings up an issue that the Model 3 was introduced in 2017 as if it's the same car 5 years later. It's not. Just because Tesla doesn't do annual year models doesn't mean the Model 3 now isn't almost a totally different vehicle than what it looked like in 2017. So I could rant on this for a while, but the last thing I'll say, Tesla needs to maintain very good liquidity. Well, it does. It has great liquidity. It has around $18 billion in cash. It's generating positive free cash flow every quarter, which remember that figure is after already taking out the CapEx expenditures, which for Tesla right now are in the neighborhood of $6 billion per year. But again, it's not like Tesla only has a 3-year runway because Tesla is funding these CapEx expenditures with the free cash flow it's generating every quarter. So I think I've made my point that this rationale and response from Moodys is completely absurd and not based in any sense of reality. For whatever it may be worth, Gary Black said one of the other ratings agencies, S&P, is smarter and more forward-thinking than Moody's. Give it until October. There was a new study done by Vanarama saying that Tesla's AI and its chips will be smarter than humans by 2033. That's not what I want to focus on, although there were some good statistics in this study. By analyzing current and previous Tesla microchips, we found their capability is increasing at a rate of 486% per year. The first chip analyzed, the NVIDIA component from 2016, was around 12 trillion operations per second, or TOPS, with the latest D1 chip managing 362 trillion TOPS. Boiling it down, some of this data reveals that this new D1 chip is around 30 times more powerful than the NVIDIA device Tesla was using 6 years ago. Just 2 quick anecdotes from the most recent Tesla VPP event. This user said that was $25 per hour. 13 kilowatt hours back to the grid during the event. For those counting, $85 in my pocket in 2 days, $135 total since July 17th. Looking at the growth being tracked by Last Bulb, as you can see, Tesla's VPP has grown to around 3,500 homes in the network, and at this last event was producing around 50 megawatts of backup capacity. There are 2 pretty interesting job postings up for Tesla. The first, a semi-service technician. Not just any service tech, this will be one of the first technicians to provide an in-person service to our new customers at the locations below, one of which being Modesto, California, meaning that Pepsi could be one of the first, as we've expected, to receive the first semi-deliveries. And the second similar posting, this one is in Reno, Nevada. The first one was for Fremont. Job description: be part of the first semi-service techs in the field, support the Tesla semi fleet that will move Tesla cargo between our own factories, and also support our first customers. In my opinion, this is a very encouraging sign for imminent Tesla semi customer deliveries, not just for Tesla's own fleet delivering products back and forth. Here we have the VP of sales for American Honda saying that lithium-ion EVs won't ever be as cheap as gas cars, saying, "We Honda don't really believe the current lithium-ion technology is the long-term solution. Instead," he said, "solid-state batteries are going to be the game changer for us." Look, will solid-state technology eventually be a game changer? Yes, probably, most likely, but that could be a decade from now until we start seeing this type of battery in mass production. Almost everybody knows right now lithium-ion batteries are the best way to start and accelerate this EV transition. We can't just sit back and wait around for all of these breakthroughs to happen in battery tech because they just don't happen fast enough. Honda did say, though, they're investing $300 million in a new experimental production line project to test mass production of these solid-state batteries. And yes, right now in the short term, battery costs are trending in the wrong direction. They're going up, but if you zoom out a little bit and look over the last decade, they've been very steadily falling in cost, going from around $1,200 per kilowatt hour down to around $132 per kilowatt hour over the last 10 years. And lastly, Gardner admitted that he basically has no idea when this solid-state technology is going to be here. These companies just seem to be all over the place with no cohesion, no direction or mission. I mean, literally just a few days ago, we heard Honda talking about investing $4 billion for a new lithium-ion battery factory. But once again, it's really just shocking and disheartening to see that there's so much of this attitude running so many different multinational, global, billion-dollar corporations. Moving to some more positive news for the EV revolution, back in 2016, there was only one vehicle getting an EPA range of over 300 miles, the Model S. Fast forward to today, that number has grown to 14 vehicles achieving that feat. Earlier this week, we touched on Warren Buffett selling a very small portion of his BYD shares and the market kind of overreacting. However, that is now starting to become a trend. He did sell another small block of shares, bringing the cumulative total to around 3 million shares sold, but he does still own around 225 million. Personally, I was very encouraged by some of these comments from VW's new CEO, Oliver Bloom. Of course, we'll have to see if they walk the walk, but he said VW will double down on EVs. Oliver said, "I'm a fan of e-mobility and I stand by this path. We will keep the current pace and, where possible, increase it." Some of you are probably more familiar with Oliver Bloom's history than myself, so I would ask you, do you trust him or is he just blowing ice smoke? I just have to say, this type of news right here, while definitely not ideal, is being blown way out of proportion and it's being politicized. All that's really going on right now is California is asking EV owners to limit the times that they charge their vehicles, mainly driven by this massive heat wave sweeping the area. I won't get into the politics of this, but if you're wondering, here's just one paragraph of an example of what's going on. A spokeswoman for the governor said, "We're not saying don't charge your EVs, we're just saying don't charge them between 4 and 9 p.m. Over the next few days, as we get Tesla's official vehicle production and delivery figures for the month of August, just wanted to show you this for some of the competition in the area to give you a frame of reference. So the expectation is around 77,000 for Tesla for August out of Giga Shanghai. So here are some comparisons. Don't forget, check out Ekster linked below. Take advantage of that Labor Day sale and my coupon code. Most likely no video on Monday for Labor Day. Please like the video if you did. Hope you guys have a safe and a very enjoyable holiday weekend, and a huge thank you to all of my Patreon supporters.